Cash and internal controls. There we go. We're going to talk about various aspects of internal controls and various control activities that companies can put into place to protect their assets, but there are always limits on internal controls. We're going to talk about controls related to merchandising organizations and ways in which we protect cash, and the person who handles the cash is separate from the person who reconciles the bank statements. And then we're going to talk about something called a petty cash system. Oftentimes there's a need for just small amounts of cash to pay for things, so it's common that someone takes care of a petty cash and keeps that reconciled. We'll talk about that, and then talk about management and the auditor and the functions of each one. Now, we've talked about this faithful representation before, but faithful representation basically means that the information we provide in the financial statements is free of any errors, is complete. It contains all the transactions of a company, and it's neutral, which means we don't have a bias to represent it in a favorable light, or for that matter, in a bad light, that it's neutral. It's important that companies' financial statements faithfully represent the company's operations, which means there aren't errors in the transactions we posted, that everything that's being represented is as it says it is. Internal control is the process that achieves this goal by establishing the reliability of the accounting records and financial statements and ensures that the company's assets are in fact protected. So merchandising companies have to protect their assets. If they don't protect their assets, they can walk away pretty easily, can't they? Now, one way of protecting the assets of a merchandising company is to monitor or control how many people get to go into the warehouse, right? And so we're going to talk about different ways that assets need to be protected and what happens when they're not protected. Taking a physical inventory helps facilitate controls over merchandise inventory. So what that means is at the end of a period or at the end of each month or however it works, to actually go and count those items and match it with what you believe is on hand will help you see if in fact what you think is on hand is truly what is on hand. What would the difference be? Theft. Could be broken items, you know, that they throw out, but generally you want to have as close or accurate as a number as you can. Taking an actual count of all the merchandise on hand is what it means to take a physical inventory. We talked last week about the periodic method and the perpetual method. The periodic method is when we use different types of accounts to keep track of purchases during the period, but then it's at the end of the period we actually take a physical count of those items still on hand at the end of the period, and the difference are all cost of goods sold. The perpetual method is where we keep track at all times of the inventory on hand and what's been sold. Even though on the perpetual method we know it's been sold, we still take a physical count to make sure that what we believe is on hand via our computer records is in fact an actual physical count and matches what we believe our computer records to be. So either method we use, we still take a physical count at the end of the period. Merchandisers usually take a physical inventory after the close of business on the last day of their fiscal year. Many companies experience losses of merchandise inventory from spoilage. Spoilage would be inventory that has a shelf life. So spoilage can happen, shoplifting can happen, theft from employees can happen. All of it, the above, can reduce inventory. Inventory shortages can also result from honest mistakes, such as incorrectly tagging inventory. So while there can be some theft on here, and there really can be legitimate reasons why the inventory may be misrepresented. The periodic system provides no means of identifying these losses because the costs are automatically included into cost of goods sold. Remember, throughout the year when we purchase items, we just add it to our purchases. Then at the end of the year, we take a physical count on what's on hand. The difference automatically goes into cost of goods sold. Under the perpetual method, we're constantly updating what our cost of goods sold is going to be. And so at the end of the period, when we take a physical count, we're actually making sure that our physical count matches what we show our inventory records on hand to be. The difference, we'll be able to know clearly how much of that is a result of either spoilage or shoplifting or theft. Because the merchandise inventory account is continually updated, the loss shows up as the difference between the inventory records and the physical inventory. So it's important to have internal controls, and one of the ways in which we have internal controls involve 5 different components. One is going to be called the control component. This control environment is created by management. Management's attitude, management's actions, encompasses what are the company's ethics, what is the philosophy of the company, and the operating style easily is permeated or exposed in how management operates a company. The organizational structure is another manner of control environment. Who reports to who? How segregated are the various duties? Authorities and responsibilities are assigned by management. Who has the authority to write checks? Who has the responsibility of segregating assets, or who has the responsibility of making sure the bank statement balances? If you keep those, whoever has the authority with the responsibility, separated, then you're more likely to catch controls that aren't operating effectively. Personnel policies and practices. How strict is a company on theft? Is it automatic termination? How strict is a company on honesty and integrity? Are we dealing with companies that are just trying to make the profits look good on paper, and they're willing to allow their employees to skip appropriate standards to achieve those end results? Are we dealing with a company that their ethics are important, that they don't want to record a sale until a sale has truly happened? Risk assessment. Oftentimes companies look at the various areas which are high potential for having loss, or where inaccuracies in accounting records can be high. So each company needs to take a look at where there could be risk in various areas. Control activities, policies, and procedures management puts in place to see that its directives are carried out is another control aspect. And then how does the company communicate the accounting system, and how are the transactions recorded, and how, basically, who records the transactions, who authorizes those transactions, and who's responsible for the final figures in the accounting records. And then monitoring. You can have systems in place, but management needs to monitor the various systems in place to really see if in fact they're working in the manner in which they're supposed to be working. So control activities, the focus or the main purpose on it is to protect companies' assets and to ensure that the accounting records can be trusted, that they're reliable. Some standard controls with the accounting records include who authorizes certain transactions. Do you need a specific supervisor or manager that authorizes those transactions before they can get recorded? Who records the transactions? Recording transactions helps establish what we see here, accountability for the assets for all transactions that get recorded. What about documents and records? Do we have backup documentation for every transaction we're recording? Well-designed documents help make sure that the transactions get properly recorded. Before transactions can be recorded, is it essential that all original paperwork is attached? Or is some paperwork missing and so you just need to have someone sign off on a transaction before it gets recorded? How thorough is that documentation? Physical controls limit access to cash, limit access to assets, also cash registers, warehouses, and storerooms, also accounting records. So can the Vice President of Finance go in to the accounting clerk's desk and just override a transaction? Do they have that authority? Or are there appropriate lines of authority in place that only certain people can access certain even parts of the accounting software? What about the warehouse? Can anyone just go in and check on the warehouse? Or are there codes as far as entering the door? Are there cameras everywhere so they see who's in the warehouse? Does that make sense what I'm saying? Periodic independent verification means someone other than the people responsible for the accounting records and assets should periodically check the records against the assets. That's a real wise move. A lot of times the scenarios that I've read about where fraud goes undetected is because those individuals that are actually committing the fraud never take a vacation, never take time away to keep the fraud up. They stay there all the time because if someone else got involved, they would clearly see that maybe the records aren't lining up. So having mandatory breaks away from the place really can also help uncover any fraudulent activity. Separation of duties means no one person should authorize the transactions and also handle the assets and also keep records of the assets. If one person's doing all that, you're going to have trouble because there is no accountability. Sound personnel practices. Personnel practices that promote internal controls include supervising someone's work, rotating key people among different jobs at different times, making employees take vacation away, bonding those personnel who handle cash or money just to protect yourself in the event that they do steal it. Bonding's the process of carefully checking on employees' background and getting, like an insurance policy, against the company, against that person in case of theft. Systems of internal controls for merchandising activities help enhance certain objectives, prevents losses of cash and inventory, ensure that records of transactions and account balances stay accurate, keeps enough inventory on hand to sell to customers without overstocking merchandise. So in other words, having enough on hand so you can have all the sales you need, but not having too much inventory on hand that it's costing you money. Keep sufficient cash on hand to pay for purchases in time to receive discounts. So those merchandising companies that are buying inventory, if they keep enough cash on hand, they can take advantage of those discounts that are available. Keep credit losses as low as possible by making credit sales only to customers who are likely to pay on time. So it might sound good that you have very liberal credit policies or limits with your various customers, and so you might sell more. But the bummer of that is sometimes the more liberal your credit policies are, you might have higher uncollectibles because you're maybe allowing people to buy things on credit that really shouldn't be purchased on credit. No system of internal controls is without weaknesses. As long as people perform control procedures, an internal control system is going to be vulnerable to humans due to misunderstandings, mistakes, carelessness, distractions, and dishonesty. Separation of duties can be defeated through employees coming together and scheming together. So segregation of duties is really a great idea. But what if you and the two other people who have the separation or segregation of duties get together and collude to create fraud together? That system's wiped out, isn't it? Sometimes controls become ineffective. So basically, the concept here is to really look about the control environment, areas within a company that risk may be present or prevalent, and various ways in which we can help protect that risk by having segregation of duties, monitoring people's activities, having appropriate communication, and an internal audit department is also another way where people are constantly monitoring the activity to make sure that the control environment is working as they expect it to be working. I'm going to take a minute and find something here.